Bitcoin, what's happening? The recent surge in Bitcoin's value surpassing $30,000 and briefly reaching $138,000 on Binance has left many puzzled. Despite negative press, including the SEC's investigation into Coinbase, the largest US exchange, Bitcoin continues to defy expectations. Meanwhile, the crypto market is anticipating a seismic shift as major asset management firms like BlackRock seek approval for a spot Bitcoin ETF. This potential ETF could open the floodgates for trillions of dollars from untapped investment sources, such as pension funds and institutional investors. As the largest asset management company globally pursues this application, questions arise about the US government's stance on cryptocurrencies. Hi! Allow me to welcome you to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. In this video, we'll explore Bitcoin ETF's workings, drawbacks, and flexibility to understand its significance. Make sure to leave a like, subscribe if you're new to our channel, and turn on the notification bell to keep posted. With that being said, let's start. Recently, Bitcoin's value surpassed $30,000, and for a brief moment on Binance, it topped $138,000. Some are baffled by Bitcoin's continued rise in the face of recent negative press, including the SEC's investigation of the biggest US exchange, Coinbase, on charges of operating an unregistered securities exchange. It would appear that the SEC is not interested in making it simpler for companies that deal in Bitcoin or cryptocurrencies to operate within the United States. But Bitcoin is doing far better than expected. A fresh wave and earthquake are supposedly on the horizon for crypto, and others are stating that the wolf has entered the henhouse. If BlackRock is a name you are unfamiliar with, it is the largest asset management firm in the world, managing assets worth close to $10 trillion. Currently, they are seeking approval for a spot Bitcoin ETF, which has the potential to grant access to an enormous amount of money, reaching trillions of dollars. This influx of funds could come from investment sources that currently do not have the ability to invest in Bitcoin, including pension funds, institutional investors, hedge funds, and sovereign funds. In addition, other well-known firms are vying for the privilege of launching their own Bitcoin ETFs, including Valkyrie, Bitwise, WisdomTree, and Invesco. They're all eyeing the trillions in assets they might oversee and profit from as managers. As a result, individuals are left with numerous inquiries regarding the current situation and the reasons behind its occurrence at this particular moment. Why is the largest asset management company globally pursuing an ETF application while the US government has explicitly expressed its reluctance to engage with Bitcoin and cryptocurrencies? When it comes to Bitcoin, how exactly does an ETF work? Simply put, an ETF or exchange-traded fund is a sum of money that is invested in a single asset. In the event of its approval, this particular Bitcoin ETF will mark a significant milestone as the first of its kind in the United States. While it's worth noting that other Bitcoin ETFs have been introduced previously, such as Canada's approval of its first ETF in 2021, there is also the long-standing presence of the Grayscale Bitcoin Trust in the US, which dates back to 2013. However, there is a significant drawback to these Bitcoin ETFs. The majority, if not all of these ETFs, require investors to meet a specific criteria known as being an accredited investor. This criteria necessitates having a substantial amount of wealth in order to gain access to purchasing these assets. Additionally, it's important to note that in most cases, these ETFs do not provide direct ownership of the underlying asset itself. For instance, let's take BITO as an example, which happens to be the first ever Bitcoin ETF created. BITO operates by trading in futures contracts, which are essentially agreements that speculate or make predictions about the future price of Bitcoin. However, it's crucial to understand that these ETFs do not directly represent owning Bitcoin itself. Furthermore, these types of ETFs generally come with a considerable high expense ratio, resulting in substantial costs for investors who wish to own them. But if you invest in the spot Bitcoin ETF, you'll have the ability to monitor its price in real time. In other words, the ETF will rise in value if the price of Bitcoin increases, and vice versa. Now, one may wonder, why is there such complexity and excitement surrounding ETFs? Why not opt for a simpler approach, such as buying Bitcoin online and transferring it to be securely stored in cold storage. Firstly, many individuals lack the time to go through the process of creating an online account on exchanges, primarily due to the diminishing trust in these platforms, particularly concerning the security of personal information like social security numbers. Secondly, the majority of people are not familiar with the procedures involved in transferring Bitcoin to a cold storage wallet. Lastly, individuals are often reluctant to take the risk of managing their own passwords and potentially losing access to their Bitcoin holdings. However, the key reason for the interest in ETFs is the flexibility they offer. A spot ETF, for instance, enables the purchase of Bitcoin through various avenues, including 401k accounts from one's employment and individual retirement accounts or IRAs like Roth and traditional IRAs. Additionally, ETFs can be utilized to determine assets under management, or AUM, enabling individuals to borrow against their assets or engage in leveraging strategies. Since this would likely be an off-chain transaction, the cost of buying and selling Bitcoin would theoretically go down as well. You could purchase Bitcoin from your preferred exchange with the same convenience and security as buying a stock from your brokerage of choice without having to create an account with an unfamiliar website. All of this has an impact not just on individual investors, but also on larger players who, at the moment, may not be permitted to participate directly in Bitcoin due to regulatory restrictions. So, if the spot Bitcoin ETF is approved, the ultimate question arises: what could happen to the price of Bitcoin? To shed light on this, let's draw a comparison with gold. In the past, gold didn't have the option of an ETF. Individuals could only purchase certificates, shares, or physically acquire the metal themselves. However, this differed from an ETF, which represents a collective pool of funds invested in the same asset. On November 18, 2004, the first gold spot ETF, known as the SPDR Gold Trust ETF or GLD, was introduced. At that time, the price of gold was below $450 per ounce. Fast forward approximately 7 years to 2011, and the price of gold surged to nearly $2,000 per ounce. While various factors contributed to gold's price increase during that period, such as distrust in government in periods of high inflation, it can also be argued that the creation of the spot ETF provided access to individuals who preferred not to physically own and securely store gold. Many people would choose this trade-off today. Now the question remains, how might this apply to Bitcoin? When you look at the top 100 asset management organizations in the world, you'll see that they handle over $57 trillion worth of assets. It would be unfair to assume that all the money would flow into Bitcoin, as that is unlikely to happen. Instead, let's consider the scenario where only 1% of that money finds its way into Bitcoin, which amounts to approximately $600 billion. Currently, Bitcoin's market cap stands at $580 billion, roughly doubling its market cap. The last time Bitcoin reached a market cap of around $1.2 trillion was in November 2021, when its price reached $67,500. However, it is important to note that this simplistic analysis is flawed because it fails to account for the true nature of a market cap. A market cap is determined by multiplying the average latest sales price across all exchanges by the total supply, which remains constant at 21 million coins in the case of Bitcoin. Consequently, it would require significantly less than $600 billion in real dollars to double the price, just as it would take much less than $600 billion worth of selling pressure to crash the price. It is crucial to understand that the market cap is merely an assumption, not an absolute fact. The actual price of Bitcoin depends on various factors, including supply, the number of coins available for sale, and what buyers are willing to pay. These dynamics can change rapidly, leading to fluctuations in the market cap. Therefore, if there were indeed $600 billion of real money entering the market, the price progression would not necessarily follow a linear path. Although we may assume that it should double based on mathematical calculations, this expectation does not always hold true in practice. Hi! It looks like you've reached the end of this video. Thank you for watching this far. Please subscribe and give a like if you enjoyed it, and comment your thoughts in the comments section. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. See you around!